Hey folks, David Frost, MyStrategicForecast.com. You're here for another episode of Common Sense Market Analysis. Today is Wednesday, April 29, 2015. Inside the numbers tonight, first we're going to discuss how to pick a bottom with good risk reward back to a trade I told you about on Monday. We're going to talk about the SPY and the E-mini contract, of course. Crude oil, a lot of action there. We'll talk about gold. That's kind of going right to plan. Interest rates in the bond market, again, right to plan. And the U.S. dollar, right to plan. Okay, this is a big deal, so let's get into the charts, all right? So the SPY and the E-mini. So we're talking about the S&P 500. Here's the daily chart of the SPY. And basically, today you had a market that was somewhat consumed by the Federal Reserve announcement. You had some GDP numbers in the morning. You had the Federal Reserve in the afternoon. So there's two ways to look at this. There's one way that says, a lot of the market was weak today. There was a lot of stocks that got taken out behind the woodshed. The transports were just whacked. The S&P was only down about 1/3 of a percent. The Dow was down a little less than 0.5%. The Nasdaq was down more than that, and the Russell was down. Let me get the percentage there because I don't remember it off the top of my head, but it's important to know. 1.25%, so commensurate with the transports. So it was kind of a mixed market out there, and so we've got a couple of things going on. Number one, the market's always going to try and trick you before it does the thing it's supposed to do. So are we going down before we head back up? That's possible, but the problem is that we're running out of time, at least in the short run, for those higher prices. So we got to 21.18 on the S&P E-mini contract. Okay, and then the next target I had was up at about 21.25, and then I was telling you 21.30.35. Well, we may have to wait a little while before we achieve those numbers. I'm not positive and I'm not 100% sure, but next week I have a short-term cycle that's due to top. And what that means is that we could see anywhere from 3 to 5 days of some downward pressure in the market, some selling pressure before trying to achieve those higher prices. The jury's still out on that. We have to see what develops in the next day or two, how the market trades tomorrow. Basically, the line in the sand now, the line in the sand, I give you lines in the sand, and sometimes the numbers move around, and the reason the numbers move is because the market moves. The market's dynamic. Your moving averages are moving up or down. Your price levels are moving up and down. Therefore, your support and resistance lines are moving up and down. So right now, the line in the sand, what is that? That can't be good. Right now, your line in the sand is basically 21.04. You've got to close 21.05 or higher in order for this market to remain bullish. So that's a pretty definitive line in the sand. Let's go over to the E-mini contract and let me show you where that is. Okay, 21.05. You have to close above this area here. Okay, in fact, I'm going to put another line in, and we're actually going to make it a different color. 21.05. All right, let's just change the color, and I'm going to leave it here. Let's see. Let's just make it one of these brown deals, and we'll make it thicker because it is the line in the sand, okay? Until and unless we close daily convincingly above 21.05, then we're basically in a more bearish tone or less bullish. Okay, that's the line in the sand. It's really not much else to do in the S&P until and unless we close above 21.05. On the way down, these numbers still stand true. Okay, we got 20.85, which we almost got to yesterday. If you go into a intraday chart here, all right, let's go into the intraday chart, and you can see where. Let's go to the hourly because I want to show you yesterday. See, we kind of almost tested it here. We made another attempt here, and then the market reversed up a little bit. But the market was consumed by the Federal Reserve today, so I'm not going to read too much into it. I need another day to determine what's what. But back to the daily, so we got 2085, 2070, 2055, and all the way down to 2020. So those are your lines on the downside, your support levels on the downside. We know where our pivot is on the upside, and if we get over 2105, then we're really going to target 2125. That's going to be the next important target on the upside. All right, let's move on. In fact, you know what? I wanted to talk about a couple of things. In the beginning of the Inside the Numbers slide, I said I want to show you a trade from Monday. So here it is, okay? What you have is, remember we were talking about natural gas down here at about $2.50, and I said the way to trade bottoms when you have a signal that the market is reversing or some kind of a reversal or bottoming signal, and this doji could be counted as such. Okay, this candle here, narrow candle, looks like a cross, and what happened was I said you can go long with a close below that day. And the close below, if you remember, was $2.48. So if we closed the day below $2.48, we were out. Otherwise, we were going to stay with the trade. And basically what happened is through today, you're up $1,000 a contract if you traded natural gas on the commodity itself. There's other ways to trade it. You could have traded UNG, could have bought options, other vehicles out there. But just in the contract of natural gas, just to give you an idea, if you were to buy one contract, you'd be up $1,000 and you would have needed $2,200 of equity in an account to trade one contract of natural gas. Two contracts, you would only have to have less than $3,000 of equity to make what would have been $2,000. So you see the leverage that goes on in the commodity markets. But just goes to show you that this is how you trade. You know where you're wrong, and as long as the market doesn't come below and close below where you're wrong, the other path is higher, and that's what happened here. Another one I want to tell you about that we discussed last night is Yelp. And this is interesting because what happened with Yelp is I told you I discussed this head and shoulders pattern last night, and I said that because we tested this neckline, that there's only one of two things that could happen. Either this pattern is going to fail and we close above this neckline, or this neckline will repel price and will head back down. Those are the only two things that could have happened. And basically what I said to you is, on a longer term basis, this is a stone cold short, because Yelp, if this pattern ever played out over the long term, is going to go to zero. Well, let's take a look at what happened. Yelp announced earnings today, and this is the reason why I didn't put it out as a trade alert and didn't take the trade. We don't trade into earnings, right? We don't know what's going to happen with earnings. In fact, if, let's say, earnings were good, or the market perceived them as good, let's go to the daily chart. What would have happened if we gapped up tomorrow? We probably would have been staring at about $56.50, $57 in the face. And who wants to be put $6 or maybe even more in your face on a gap up after earnings because you were gambling playing a stock into earnings? That's why we never hold anything and we never trade anything into earnings. We let earnings play for themselves, and we just let the chart tell us what to do after the fact. Okay, so what happened today? Well, let's go and look at what happened after earnings. Okay, Yelp did this. Okay, it's now trading at 43.5. Last night, it was over 51 when I talked to you about this. Okay, that's a pretty good move. Listen, folks, Yelp is going down. It's just a matter of how long it's going to take. So now we're trading right here as of the close after market today, okay? Is there going to be more downside in Yelp as long as something doesn't change between now and the morning? Yeah, that's not going to be the end of the sell-off in Yelp. That's the beginning of the next selling wave in Yelp. Okay. So you heard it here first. Talked about Yelp last night, stone cold short. Today it's down $8 or $7 in the aftermarket. Okay, let's go to gold. Nothing wrong with gold. Gold is doing pretty much, let's go to the daily chart. It's doing pretty much what I suspected it would do, right? We stalled out at the 1212 area. I said that we would most likely find resistance at 1212, and if we weren't able to close above 1212, then we would most likely come back and maybe test this 20-period moving average or slightly below. I think the number's 1195. 1195 is all I'm expecting on the downside, and what that does is it gives us one of those ABC patterns, right? A, B, C. We had an A, B, C pattern here in development on the larger picture, but on a smaller scale, A, B, C, and I think that's what's developing here. If we convincingly close below 1195, then I think there's something else developing. But that's what my work is telling me. So we can look for more upside, higher prices of gold, but it's got to pull back first, most likely for the remainder of this week. GDX, not bad. GDX scratched out an up day. Remember what I was telling you last night. You need to be selling into strength in GDX, specifically if you get up to this 200 period moving average. I'm not sure how much upside is left on the after we get up to this 2150 level. Let's call it 2135 to 2150. I'd like to see how the market reacts to that level and what kind of price action develops off that level before remaining or taking a long position at that point. So if you're long now, I would take some off at minimum and at least trail your stop when we get up to that. Sell into strength. That's always a smart thing to do. Oil today. Okay, oil, we're in business. So what I was telling you in oil, in fact, let's go to the hourly chart because it's much more dramatic when I show it to you this way. Oh, the line disappeared. Where'd the line go? Let me see if I can bring it back in. Nope. Okay. So let's go back to the daily. Basically, you're above our line in the sand. And remember when I said if we closed above $58 in oil, then we were going to most likely, or at least the probabilities were leaning in our favor for higher prices. That's what's happening. Okay, we closed above 58. The market got as high as, I think, 58.70 today, something in that neighborhood. And we can look for higher prices yet. I think, in fact, where was the high today? The high was, 59.33, pardon me. So I think there's higher prices. You can see how this pattern is playing out like I said it would. Long sideways consolidation usually portends higher prices on the upside. And what I told you is if you wanted to take a long, right, you could have done it against this low here. Okay, 55.76 was your first level of support. 54.88 was your second level of support. Any break of those levels closes below those levels, you would just move out of the trade. But we don't have to worry about that because now anybody that took the trade should have at minimum of a break-even stop or one in the money, and you should begin to look to take some off when we get to about $60 a barrel, assuming we get there in the next day or so. I think we will. I think we can go as high as about $64 a barrel on this run. Does that mean by Friday or Monday? No, not necessarily. But before we begin a pullback in earnest, I'm going to go out on a limb and say we could see a possibility of 64. I'm saying we will see 60. Higher than 60, I'm just saying the probabilities are better than 50%, but they're not good enough to stay in a trade yet at this point over $60. But I am holding up to $60. Okay, so everybody should have had a nice trade in that one. The bond market. Bond market did pretty much exactly what I said it was going to do over the last couple of days. I said we were going to wait for the market to tell us what to do. Okay, and I said we would most likely come into the 125.50, which is this line going across here. And you can go back and check those videos. This line was in there for a few days. And what did we do today? We came down right into that line, pierced through it, made a low of 125.28, and then finished with what's called a doji candle. Now, this isn't at the low of the chart, so it's not considered a reversal signal yet. But we did have good volume today. And the other thing is, I have a daily cycle bottom today plus or minus 1 day, which means now it's plus 1 day. Okay, it's either today, we made a bottom today, or we'll make one tomorrow in the bond market, which means higher prices yet again in bonds. And what does that mean? Where? So on a bounce, we're going to look for probably a $3, $2.50 to $3 bounce on the TLT on the upside. I think that's worth a little money in the pocket. So those of you that want to take that trade, go ahead. All you do is you put a stop below today's low on a daily closing basis. Actually, you would want to see how the market traded tomorrow. Unless we were absolutely selling off hard tomorrow down to this line, you would want to wait to see how the market's developing. Because the turn is plus 1 day, it's today plus or minus, so now it's just plus 1 day. But I would expect a $2.50 to $3.50 bounce, maybe up to the these will converge by the time you get there, the 20 and the 50 period moving average. So I'm going to say you might even get as high as about 129 when we get there on a bounce back up north. Okay, so what does that mean for yields? This is the 10-year yield. That's going to mean lower yields yet. What would that mean for the stock market? Possibly we would see downward pressure on the stock market, higher bond prices, lower yields. That is typically a correlation that does exist, not all the time, but it does exist a lot of the times. So I'm watching. The IWM has been weak. I'm watching the bonds. I'm watching the dollar. I'm watching all this stuff, and I'm giving you everything I've got. And what I'm seeing is everything I'm telling you. So I'm seeing lower yields ahead, higher bond prices ahead, higher price of oil. That could be due to something else. Who knows? Let's go over to the dollar. The U.S. dollar, what do you know? We came right into the zone. How long have I been saying we got to come back and test that low here right into this zone? I've had this here for 5 or 6 weeks, this channel with the buy zone here. Today's your day. Today was your day. If you want to be long the dollar, today it gave you every reason to buy the dollar. It came into the zone. This is another daily cycle bottom, just like bonds in the dollar today, plus 1 day. Okay. The dollar's been selling off for quite some time. Okay, we came in to test this low. Okay, this low was 94.76. Today's low is 94.75. That's a bona fide test. I think there's higher prices coming in the dollar, and you know how I feel longer term. I think we're going to see minimum 105 up to 110 in the price of the dollar. We're at 95 here. That's 10 to 15 points on the upside in the dollar. Okay, you don't get that kind of move, and you don't get this kind of an opportunity in currencies every day. You should be buying the dollar, and I've been saying this for days and days and days. In the middle of this zone, it's a buy with 3 hands. Okay, everybody should have been buying the dollar with 3 hands. All right, I'm going to give it a wrap there tonight. Hopefully it's helpful, folks. I'm giving you everything I've got. I'm David Frost, mystrategicforecast.com. Thanks for tuning in for another episode of Common Sense Market Analysis.